The TTF and NBP front month and front season products are ready to move higher at the start of this week, whereas EUAs and German power are looking to move lower. My name is Marcello Colax. It's the 19th of January 2026, and I am walking you through the European energy charts for the week ahead. Everything you see here, of course, is just my personal opinion and does not constitute trading advice. All right, this is the TTF sentiment benchmark that we have for you at the start of this week. We usually get between 150 to 200 responses on our LinkedIn survey where we are asking energy professionals where they think the TTF is going to go this week. Every single person that votes here actually has a stake in the market, so this makes it the industry's most comprehensive and reliable sentiment survey. We can see that 1 week ago we did have bearish dominance with 44%, which has switched to bullish dominance with 50%. The bears only represented with 34%, and then we do have 10% of you who believe that the market is most likely going to go sideways. So how do we make use of this sentiment? Let me show you an example. At the start of this year, we had a strongly bullish sentiment, but the charts were showing us that the market is more likely to drop lower. Since most of the market was bullish inclined, a lot of traders were on the wrong side of the market and they had to close out their longs, which initially pushed the price even lower than it would have otherwise. So here we did see a bearish setup on the charts, but we did have a bullish sentiment, which only made the decline worse. Then a week later, we did get a bearish sentiment, but the charts were showing us that the market is strongly bullish. So this showed us that there was more traders to be on the wrong side of the market. So when we opened on the 12th of January, a lot of traders were very wrong, so they had to close out their shorts, which initially fueled this entire up leg that we are confronted with right now. Now, what is happening this week? This week, essentially, it is all aligned. So the TTF charts are showing us that a strong open is possible. And we are also seeing that the market is more bullish inclined. So there's no discrepancy here. The gains are more likely to continue. This is the front page of our dashboard this Monday morning for our clients. So you can see that the TTF, NBP, German Power, and EUAs are still all strongly bullish. We do expect the TTF and NBP to continue higher, but we do expect the German Power and EUAs to push lower because what we are showing here are not forecasts. They are simply showing us what the market is currently doing. And that is a lot more useful than any old price forecast. What that means specifically for German Power and EUAs, I'll show you in a second. If you want a more detailed analysis directly in your inbox, then do subscribe to our newsletter. It is completely for free. Every Monday morning at 7 a.m. CET, we are sharing with you our latest views on the European energy markets. Some of your industry peers are telling us that our free newsletter is better than the paid stuff out there available with legacy providers. So now let's have a look at the TTF front month daily chart. I'll quickly walk you through our methodology so you can replicate it on your own. So what we're seeing here is that we had 1, 2, 3, 4, 5, maybe 6 good old green candles in a row with prices pushing above the 200-day exponential moving average. We also pushed above this resistance area that was holding for quite some time since mid-December. We saw that the volume is rising significantly, and we see that tools overall are still bullish inclined. More on that in just a second. So overall, what we need now is a move above 83.06, which is the peak from last Friday, in order to continue this bullish trend. Even if we were to get a smaller bearish corrective move, as long as the corrections remain above the 61.8% Fib retracement, in our case, this would be 31.23, we believe that immediate upside continuation is more likely. Why is that? First things first, let's have a look at the trend. Is the trend bullish, bearish, or neutral? So for that, first of all, of course, above the 200 EMA, above the most recent peak. And we're also seeing that the 8 and 12 exponential moving averages are pointing higher. So overall, the trend is bullish. Then we do look at the momentum because the momentum is telling us how strongly the bulls are represented in the market. Here we are looking at the MACD, the moving average convergence divergence. We are well above the zero line, which is a bullish signal. We are pointing higher quite strongly. So this is another bullish signal. So the market is going up, and it's strongly going up. The bulls are convinced. Then what I like to do, especially after such a strong rise, I like to look at the stochastic. So the stochastic is our oscillator of choice. So moving into overbought territory is not the bearish signal. Moving out of it would be a bearish signal. Same thing on the opposite, right? Just for example, moving into the oversold territory is not a bullish signal. Moving out of it is the bullish signal. Can you see? Moving into it is not the bullish signal. Moving out of it is the bullish signal. And that's exactly happening here. We are now in overbought territory, which is not a bearish signal. It simply means that the trend's going on. Okay. So that's why we believe that the market is more likely to push higher, potentially towards 42.44. Now, this is getting like very tricky to trade on a daily chart, especially since we have like no pullback. We only have green candles. So if we stay on the daily chart, we would be just hoping that the next candle is going to be green, or maybe you're hoping for a corrective move lower to find a better entry. Well, this is not done on the daily chart. Here we really want to look into the hourly chart because this is where the trading opportunities currently are. You can see instead of dealing just with green or red candles, here we are dealing with swings. So we have an upswing and a correction, and an upswing and a correction, and an upswing and a correction, right? So if we are relying on the hourly chart, we will be much better prepared for an eventual corrective move lower or to confirm the bullishness higher. So as a precaution, you can see we have put on Fibonacci retracement levels with the 0 up here at 38.06, which is the peak from last Friday, and the 100 down here at 27.05, which is the trough from the 8th of January. Now, this is only tentatively put on because you can see here, last Friday, we did have 3 consecutive bullish exhaustion candles. So this here, I don't know really, maybe a spinning top. It's not really anything, but it's a small body and a long wick. So showing us there's potential for bullish exhaustion. Then we have this candle pattern happening here, which is almost like a shooting star, a long upper wick, a small body, and a tiny lower wick. Then we do have a hanging man, which is another bearish candle in theory, with a long lower wick and a smaller body. Now, all of these usually set the market up for a decline. So, and we can see that on the stochastic, we almost got a bearish signal. So it was pointing lower already. But until these are confirmed with a move below the whole area, so in this case it would have been 36.01, which is the hanging man low, and with the confirming bearish oscillator signal, which we also didn't get, this is just a tentative bearish pattern, and we are not acting on tentative patterns. And then the market simply continued higher. So technical analysis showed us this setup and then immediately told us when it is invalidated. And that is the true value of TA with trend identification, trade planning, and risk management. So what do we do this Monday? Well, we put on these FIBs, and if we get an hourly close below the 23.6% FIB retracement at 35.47, then the alternative case will play out and we might get a corrective move lower. The first point of call would be 33.8, which is the 38.2% FIB retracement. If we get a deeper corrective move, then we could make it all the way towards the 31.26. If we bottom out here, or maybe even up here, then eventual upside continuation is still likely. Why do we still keep a bullish view even if the market is going down temporarily? So how do we differentiate between corrections and reversals? Well, for that, we want to start looking at the MACD because as the price was going up, the MACD, our momentum tool, was still pushing higher as well. So overall, the market is pretty much convinced of this bullish direction, and any sort of corrective move will just be a temporary decline before the bulls continue. So this is where the buying opportunities are. Now, here's the thing. For anyone who has to physically log in some volume, you're confronted with 2 choices now. You can either hope for the market to start a correction below 35.47. That will tell you to maybe wait it out until we actually bottom out to find a buying opportunity. If we immediately push higher above 38.06 and you see that your purchasing window is closing, then this might be the last chance for you to get volume on the cheap. It's not going to get any better anytime soon, probably. And then if you still have enough time left, you might be willing to wait it out a little bit to make use of any correction. Now, here's another predicament for all the physical traders out here. If we immediately push higher and get a corrective move, is this going to be a better price than buying right now? I also don't have an answer for that, but now at least you're working with a very clearly defined risk profile, right? Buying at 38.06 and missing out on a correction that would be kicked off below 35.47, not very likely, or buying now and getting a good value for a market that is expected to push higher. Because any subsequent corrective move lower, here the question is, will this be a better price than just getting it right now? So do have a conversation with your stakeholders. You can show them exactly these scenarios and then help them to make a decision. For all the speculative traders out here, some might choose to trade a corrective down leg if we get a move below 23.6%. Then as we bottom out, this might be a good buying opportunity. Or if we immediately push above 38.6, this might be an interesting trend following approach as well. For now, with the evidence available to us, more gains seem most likely. Now let's have a very quick look at the NBP front month, which is showing us a very, very similar picture. Here on the NBP front month, you can see exactly. We have pushed above the resistance area in the 76 pence per therm area. We pushed above the 200-day exponential moving average. Looking at the hourly chart, any sort of bearish setup was undone with the last hourly session, and we do have our very clearly defined VIP retracements that would give us a bearish corrective signal below 92.92, and the bulls would simply continue above 99.96. Now let's have a look at the German power markets. Here, I'm going directly onto the daily chart. I zoom out and you will see that we have been dealing with this ascending triangle for the longest time. So this year goes back all the way to February 2024. And the market is moving into an increasingly tighter range here. We have now reached the upper end of this triangle near 87.75. We did get our first bearish candle pattern here, which is a shooting star. We did see that the stochastic has topped out and we did get a preliminary bearish signal with the white line moving below the orange line, %K moving below %D. But once again, this is only a setup. We really need to see a move below it, like we did here and here, a move below the overbought territory before we can actually get a real bearish signal. You can see that the bearish validation level sits right where the 23.6% FIB retracement also is at a 86.90. Once again, we do put the 0 up here at the 88.4 and we put the 100 down here at the 81.95. A move below the 23.6% FIB retracement would kick off a corrective move. Potentially, it could go to the 61.8% FIB near 84.5. Once again, let's talk about multi-time frame analysis. We will not trade or even observe this corrective down leg on the daily chart. For that, we want to look at the hourly chart because here, once again, we want to be dealing with swings, not with guessing individual candles. And if we do get a move below on the hourly chart 86.14, or even below this year, honestly, I want to say, below 86.79, then we know that the bears are more likely to continue this corrective move. So how likely is this? Quite a bit more likely. Have a look at this. Stochastic already gave a bearish signal, and we also saw that the MACD shows us bearish divergence. So divergence simply means the momentum goes down while the price is still going up. So this is showing us that the bulls are exhausted. Do you remember when we were talking about divergence on the TTF, where the price was moving higher and the MACD was also still moving higher, which means that the corrective move that is anticipated, if any comes, is more likely to be a correction in an underlying uptrend. Here on the German power markets, we are seeing that while the price was still moving up, the MACD was already moving down. So very different. So this means the bulls are exhausted, which usually means that the corrective down move is going to be more extensive or could even lead to a bearish reversal. And this is how you combine momentum tools, oscillators, and chart reading to differentiate between corrections and reversals. And let's be honest, on top of that, all of this is happening at this long-term resistance area, which makes it a little bit more likely that the market will turn down towards the 61.8% FIB retracement before the bulls can try again. Right? So what's looking like full-on bullish exhaustion on the hourly chart might just be an extensive corrective move on the daily chart. So that's why we are aiming here for the deeper correction. Now let's have a look at the EUAs. Directly on the weekly chart here, yes, I am zooming out a little bit. In case you're wondering, yes, this is the new outright product. We are not stitching those together. We can see volume is picking up. Of course, it has been. It's a new contract. It's a new year. And we are immediately hitting this longer term channel that has been in place since, let's have a look, since February 2024. So now we are right here. And the EUAs, and that's best exemplified on the daily chart, have a very particular character. So what we've been seeing for quite some time is that the EUAs have long periods of a sideways trend followed by one significant move higher before the market starts moving sideways again. You can see here, right? Sideways trend, move higher. Correction, sideways trend, move higher. Sideways trend, move higher. Correction, sideways trend, move higher. So right now we are at the upper end of the rising channel. Last Thursday and Friday, we did get these two identical bearish reversal candles. Some might call this, almost a gravestone doji or a long-legged doji or a doji star. But what it means is the bulls tried to push higher twice, didn't quite cut it, and we kind of ended up where we started. So the bulls are exhausted. All of this is also happening at the upper end of this rising channel. And you can see on the stochastic, we are getting this bearish signal with the move below 80, the move below overbought territory. So the market is set up for decline. How low can it go? Well, for now, we put in the lower end of the channel, which is near 88, but we are not 100% sure because, as we said before, sideways move, moving higher, sideways move, moving higher. So we're not entirely sure how low it can go. But if we move below 90.22, which is this trough here from the 14th of January, then we'll probably see a more pronounced corrective move lower. Eventually, we still think that the bulls will remain in charge because there is no divergence on the MACD. You can see that the MACD is still overall pushing higher. So we might just see a correction before it moves onwards. Now, let's have a look at the hourly chart. Here we are dealing with a double top. So a double top simply means that the bulls tried and then tried again to push past 93.8. We did put in this neckline at 91.73. And if we get an hourly close this morning below it, then a correction would kick in. The initial target is simply by measuring the height of the double top, so 93.8 minus 91.73. Then you apply this to the downside, and this is our initial target. So it would lead us somewhere in the 89 area, but we do believe there's a chance for us to push even lower. You can see here, once again, talking about divergence and oscillators and stochastic and all of that. The stochastic oscillator started to make lower lows and lower highs, while the market was still making equal highs. So this once again showing us that this double top is more likely to play out. We've also seen that the MACD is making lower peaks and lower troughs now as well. So the market is more likely to have topped out. And here on the hourly chart, also the question is like, how low will it go? For this, we do something called multi-time frame analysis. And here we simply refer back to the daily chart's downside target overall. Once again, if you want more details on the week ahead, then do subscribe to the newsletter. Everyone, have a safe week ahead. See you around and bye-bye.